AI-powered equities are pressing up against record highs, just as oil and bond yields break higher, squeezing the traditional safety valves in multi-asset portfolios. Welcome to vTalkInsight / Allocator's Lens Daily for May 12, 2026, where we connect equities, rates, credit, foreign exchange, and commodities into one coherent view. In equities, the defining feature today is how far prices have run ahead of many traditional macro warning lights. Global benchmarks, including the S&P 500 and major tech indices, are hovering near all-time highs, while volatility gauges sit in the high teens, signaling only moderate concern despite clear pressure from oil and yields. The core engine of this move remains the AI and semiconductor complex. One global semiconductor index is up around 66% year-to-date. Hyperscalers are projected to spend well over $800 billion on chips and data centers, and large tech earnings have beaten expectations by a wide margin, with some firms posting growth far above even their own bullish forecasts. That AI build-out sits on top of a wider capital expenditure boom driven by energy security, defense, and supply chain rewiring. This wave of spending is structurally lifting earnings and margins across parts of industrials, energy infrastructure, and select emerging markets, with markets like South Korea and Taiwan highlighted as key vehicles for tapping AI-related growth. Beneath the headline levels, though, leadership remains unusually narrow. A handful of semiconductor names account for a very large share of S&P 500 returns. Only about half of index constituents trade above their medium-term trend, and market participants are increasingly worried about how hard it is to hedge such a concentrated, AI-driven risk profile. Valuation signals reinforce that tension. On some metrics, such as cyclically adjusted earnings multiples, U.S. equities are only modestly below late 1990s peaks, dividend yields are at record lows, and parts of the memory chip space already embed a very long demand supercycle, leaving little room for disappointment once supply catches up later in the decade. There are also questions about earnings quality in the most popular parts of the trade. Some chip makers recognize hyperscaler sales upfront while amortizing related costs over years, potentially flattering near-term profitability, and the sector remains inherently cyclical, even if the current capex shock may delay the usual downturn. Flows and positioning add another layer. Client portfolios still hold elevated cash levels. Hedge funds have the risk and are running with more downside protection than upside exposure. And yet the prevailing narrative describes a golden era for AI, where pullbacks are treated as opportunities until the core AI trade itself falters. Under the surface, some rotation is taking place. Small caps have started to outperform large caps. Non-U.S. and value segments are showing relative strength, and energy and defense stocks are benefiting from higher oil prices and geopolitical uncertainty, even as consumer-facing sectors and materials contribute far less to index-level gains. For equities, the near-term balance of forces is between extraordinary AI and capex-driven earnings on one side and mounting inflation, energy, and valuation risks on the other. If inflation data cooperate and the energy shock remains contained, earnings could continue to carry equities higher, but a sharper inflation or growth scare or moderation in AI spending could quickly expose how much of this rally rests on high multiples and narrow leadership, which takes us directly to the rates backdrop. In rates, the story has shifted decisively toward higher for longer policy and rising term premia. Persistent inflation above target and a still resilient U.S. labor market have pushed expectations for Federal Reserve cuts out toward 2027, and some participants even float the possibility of another hike if price pressures accelerate further. Upcoming U.S. inflation releases are therefore pivotal. Headline consumer prices are expected to move toward 3.7%, the highest in several years, while the Fed's preferred core PCE measure is rising even faster, helped by massive AI-related infrastructure spending and sticky service sector inflation, all against the backdrop of a looming leadership transition at the Fed and limited room for a dovish shift. Higher oil prices and fiscal concerns are feeding directly into bond markets. U.S. yields have risen across the curve as inflation expectations edge up and worries grow about persistent deficits, while in Europe and the UK, bond yields are climbing on both energy-driven inflation risk and domestic political uncertainty, with UK gilts carrying a notable political risk premium and elevated term premium. This environment challenges traditional duration-heavy allocations. Higher real and nominal yields reduce the protective role of government bonds in equity drawdowns, complicate the classic 60-40 portfolio, and are prompting growing interest in instruments that adjust with rates or compensate directly for inflation rather than relying on price appreciation from falling yields. Over the medium term, some comfort comes from expectations that inflation will gradually ease without a sharp deterioration in the labor market, helped eventually by productivity gains from AI and continued supply chain adaptation. But for now, the near-term skew remains toward upside inflation surprises, especially with China reflating and energy shocks still unresolved, which keeps upward pressure on yields and sets the backdrop against which credit risk is being priced. Credit markets present a split picture. In public markets, high-yield spreads have tightened to levels last seen in 2007, and investment-grade spreads remain stable despite a surge in issuance, including from U.S. hyperscalers tapping overseas markets as they fund vast AI and data center plans. That tightness signals strong risk appetite and solid demand for income, but it also means limited cushion if growth or inflation surprise negatively. With government bond yields already elevated, the incremental compensation for taking corporate credit risk looks thin by historical standards, especially if higher for longer policy keeps refinancing costs elevated for weaker borrowers. The more worrying signs are emerging in private credit and business development companies. Defaults in one large mid-market lending fund have risen notably over recent quarters. Another high-profile vehicle has required fresh sponsor capital, fee waivers, and a share buyback to stabilize confidence, and some portfolios are being marked down and offered at discounts to net asset value, with problems traced more to underwriting and due diligence than to AI disruption. At the same time, the rapid expansion of AI-related infrastructure is creating new credit opportunities and risks. Investors financing large data center projects are insisting on strong covenants and flexible capital structures to guard against delays or shifts in hyperscaler plans, and the wide dispersion between high-quality cash-generative issuers and more leveraged borrowers is reinforcing demand for long, short, and market-neutral approaches that can exploit, rather than simply absorb, that dispersion. Foreign exchange markets are reflecting this cross-asset uncertainty in a more nuanced way. The U.S. dollar has not gained decisive momentum despite strong jobs data and resilient S&P earnings, suggesting that much of the higher-for-longer story is already in the price, and that traders are reluctant to add directional exposure ahead of key inflation prints. In the developed world, Japan remains a focal point. Recent signs of official support for the yen and upcoming meetings with U.S. Treasury officials have heightened sensitivity around potential criticism of Japan's currency policy, adding to volatility in yen assets, while sterling has been surprisingly stable against peers even as gilt yields swing on domestic political and fiscal headlines. Among emerging markets, currency performance is increasingly tied to energy exposure. The Indian rupee has slipped to record lows as high fuel prices strain the economy, prompting government appeals for energy conservation and reduced overseas travel, underlining how an extended oil shock could pressure other energy importers through both inflation and external accounts, and making the next leg of the oil story critical for FX as well as rates. Commodities, and oil in particular, remain the macro swing factor tying much of this together. Brent crude is holding in a band around $100 per barrel after a sharp move higher, and West Texas prices are approaching the high 90s, as stalled peace efforts between the U.S. and Iran, submarine deployments, and ongoing threats to the Strait of Hormuz keep a significant geopolitical risk premium embedded in energy. Refined products paint an even starker picture. Diesel crack spreads have surged to conflict-era highs. Jet fuel inventories, while still above seasonal norms in the U.S., are at risk of being drawn down if supply losses persist, and disruptions through the strait are delaying shipments of key inputs like fertilizer, helium, and naphtha, gradually eroding global buffers and raising the odds of future price spikes. The macro implications are far-reaching. Persistent energy tightness is likely to seep into headline and core inflation over coming quarters, amplifying stagflation fears in Europe, intensifying pressure on energy importing economies such as India, and feeding back into higher bond yields, sector rotation within equities toward energy and infrastructure, and renewed focus on assets that can help portfolios cope with a world of higher inflation volatility. Stepping back, the cross-asset picture today is one of powerful AI and capex-driven equity strength running alongside a slow grind higher in yields, a persistent oil risk premium, and emerging stress in pockets of credit and currency markets. Equities are benefiting from exceptional earnings and capital spending, yet breadth is thin and valuations are demanding. Rates are locked into a higher-for-longer stance as inflation and energy risks linger. Public credit is priced for perfection while private credit reveals cracks. FX is quietly signaling which economies can best absorb dearer energy. And commodities sit at the center of the inflation and growth trade-off. For allocators, the key watch points now are the next round of U.S. inflation data, the trajectory of negotiations and shipping flows around the Strait of Hormuz, any shift in AI capex guidance, and whether the current disconnect between buoyant equities and rising yields begins to close through prices, earnings, or policy. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.